topic of how local areas are working to expand the financial support they offer to residents wanting to make home improvements. This is the first in our series of webinars at Aging Better that brings together learning from our extensive program of work focused on improving the quality of our homes. We know that homes are the foundation to a good life, but at the moment, far too many people are missing out on a decent home, with almost 8 million people living in homes across all tenures that are cold, damp, and unsafe. My name is Ploy, and I'm an Innovation and Change Manager in our Homes team. I've been working at Aging Better for over 3 years now, 5 years now even, with my recent work focusing on how services need to be designed to support and enable individuals to improve their home. Today, you will have the opportunity to hear from places and organizations who took part in our research, and that's Sheffield City Council and the Parity Trust. They are both effectively supporting residents to make changes to their home through providing access to finance. Paul Smith from Foundations, the organization that conducted our recently published research, will also be sharing a few insights from the research, and there'll be time for questions from the audience at the end. Unfortunately, today, our speaker from Somerset Independence Plus is no longer able to join us, but Heather was planning on talking about the local authority's role in the loan process, and in particular, how Somerset Council are supporting those who've received a loan to make changes to their home by providing them with the confidence and capability to do so, do their wraparound management and support service. It's a shame that Heather's not able to join us today, but we will share her slides with attendees afterwards. And I do know that they are planning a future webinar over the next few months about their work, so we can signpost people onto that once we know more. So we hope that by the end of today, some of these models and the conversations in this room will inspire you, whether you work at a local authority, for national government, or a local charity, to think about what more can be done to support people to access the finance they need to stay safe and warm in their home. A few quick housekeeping notes from me before we start. So we are recording this webinar, which will be made available to view on demand after we've finished. Slides will also be circulated after. And all live attendees are currently in listen-only mode. So if you have questions for the panel, and please do have questions, post these to us using the Q&A box, which will be found in the control ribbon, either in the top or the bottom of your screen. You're also welcome to use the chat box for any comments or responses you have throughout the webinar as well. So before we move on, I'll just quickly tell you a little bit about the Centre for Aging Better. So you can see a bit more about us if you haven't come across it before, and why we're interested in the space. So we are a charitable foundation. We were set up in response to the rapidly changing population in the UK and the fact that we are living longer. So as this infographic on this slide depicts, the population aged 65 and over in the UK is projected to increase by almost a third in the next 20 years. And we believe that everyone has the right to a good life as they get older, and we know that our whole society benefits when people are able to age well. But at the moment, we know that far too many people face huge barriers and as a result are living in bad housing, dealing with poverty and poor health, and made to feel invisible in their communities and society. So the Centre for Aging Better is working to make aging better a reality for everyone. And we work across a number of areas, including challenging ageism and age-friendly employment. But the work specifically focused on today is age-friendly homes. So financing home improvements. Why is this important? So we know that poor quality housing affects people of all ages. And we know that these homes can pose serious risks to people's health and well-being, particularly as they age. People aged 55 and over account for half of NHS expenditure related to poor quality housing. That's £595 million a year spent treating people aged 55 and over. And this is despite only a third of non-decent homes in England being lived in by this age group. So to improve people's health and well-being and to save the NHS money, we need to address the poor quality of our homes. In 2020, the Centre for Aging Better commissioned a Good Home Inquiry to identify what the causes of and solutions to poor quality homes were. And the biggest barrier that came up time and time again in conversations that we had with people struggling to make changes to their home was finance. Local authorities used to be the key source of financial support for homeowners, landlords, and tenants. But with the withdrawal of £2 billion in private sector grant funding by national government between 2010-11 and 2020-21 means that this landscape now looks very different. And the grant funding that remains, which is primarily directed towards disabled facilities grants, doesn't get us far enough to address the massive scale of the problem. Across the country, the scale of investment required to make all homes safe, comfortable, and more environmentally friendly is significant. And addressing this problem will require a mix of finance options, so grants, loans, and financing from both public and private sources that support and encourage individuals with different levels of ability to pay. So in terms of what we are doing about this, so to understand more about access to financial support, we commissioned foundations to develop case studies with 5 areas who are supporting people to make changes to their home through different finance models. And this research was published in 3 reports in April 2024, a link to which will be made available in the chat, and was about showcasing what innovative and good practice local areas were employing that was leading to improved outcomes for their residents. These case studies explored various models such as discretionary grants, in-house loans, externally administered loans, area renewal schemes, and support for those able to pay. And we wanted to take the opportunity to really use this webinar to delve a little bit deeper into some of these models. And in particular, we wanted to explore how local places are making their money go further through focusing specifically on models in the report that can help with sustainability. So looking beyond grants to those operating loans. So we've invited a number of speakers here to talk about their work today, and I would like to invite them to please turn on their cameras now so that the audience can see them. And our first speaker today is Denise Devoto, who's the Regional Loans Manager from Sheffield City Council's Homes and Loans Service. So Sheffield Homes and Loans administer loans for other local authorities in a consortium of councils in the Yorkshire and Humberside region. So she will be telling us about how and why this consortium approach was set up, how it works across the different areas, key learning from the scheme, and also the impact the service has had. Nick Webb, the Mortgage Operations Manager from the Parity Trust, will then be speaking. So the Parity Trusts are a non-profit lender who work across a number of areas, administering loans on behalf of local authorities. So he will also be talking through the work that they do, in particular through their partnership with Eastleigh Borough Council, which was one of the case studies in our research, including how the external loan administration model works, how they support residents, and the impact these types of loans can make. And then lastly, we've got Paul Smith, Director of Foundations, the team that conducted the research from this work, who will be briefly drawing out how these models link to the wider findings from our research. So we've got a host of speakers lined up, so I'll pass on to our first speaker, Denise Devoto, and if the other panelists just close your cameras, thank you.
Okay, good morning, everyone, and thank you, Ploy, for the introduction. As Ploy has said, I'm Denise Devoto. I'm the Regional Loans Manager of the Homes and Loans Service in Sheffield City Council. And I'm here today to talk to you about how we set our scheme up, why, etc., and just what we've achieved in the 20 years since we've been established. Next slide, please. Okay, so just a little bit of background about Homes and Loans and why we were set up by Sheffield City Council. Following the implementation of the Regulatory Reform Order in 2002, an initial group of local authorities in 2003 across South and West Yorkshire submitted a bid to the Regional Housing Board Fund, and it was for Sheffield to be the lead and the accountable body to set up the scheme. We did this because it was more efficient for one local authority to take the lead so that a loan administration service needn't be duplicated across the region. And it was to help move local authority residents and vulnerable clients away from a grant system that was in place then and onto actually being able to take responsibility through loans being secured on their own properties. So originally we were going to work with a third-party lender, but there was some mortgage guidance that was issued in 2005. And as myself and one of my colleagues, Dean, were CMAT qualified, we were then responsible for growing the team. And the decision was taken to bring the service in-house and for us to provide the service across the region. We had an initial fund of £2 million so that the 9 local authorities across South and West Yorkshire could set up the service. And then we had a further 12 local authorities that joined the service by 2006, giving us a consortium of 21 local authorities across the region that we were working with. The first loan that we developed was the Home Appreciation Loan, and this was used for repairs, improvements and disabled adaptations, which were used to support their most vulnerable applicants who were unable to access commercial borrowing from a high street lender. We are very much classed as a lender of last resort. So if a vulnerable client is able to access commercial borrowing, that is what we would expect them to do. But if they can't for whatever reason, and we know that many vulnerable clients don't tick the social boxes that banks and lenders need nowadays to be able to lend to them, and that's where we step in across the region. Next slide, please. Thank you. Okay, so what funding did we have to develop the service? From 2004 to 2011, we received approximately £7.4 million worth of funding from the Regional Housing Board that was in place at that time. All service running costs were covered by the fund, and it enabled us to provide that service free of charge to the 21 authorities that we were working with. Individual local authorities also provided their own capital programme so that they could top up the fund and actually give more loans in their area. In 2011, unfortunately, the Regional Housing Board funding ceased, and we very nearly had to cease too. As Ploy has just said, an awful large amount of funding was withdrawn from the private sector, which has now contributed to the state of some of our homes now that our most vulnerable people live in. We've been able to maintain the service, and we've provided service to local authorities who continue to fund their own HALs, and we have a core group of about 7 to 8 local authorities, some of whom have joined the call today. So, you know, we've been able to maintain the service and continue to help the vulnerable people in need. So this means because the service running costs continue to be met from our original reservoir of HALs that have been repaid over the years, it means that the service doesn't currently charge any of the local authorities for the service, and we've got sufficient resources to forecast running costs until approximately 2039. If future funds don't become available, then unfortunately an exit strategy will be needed, but it's hoped that in that time that, you know, we will be able to secure further funding to secure the longevity of the service and the important role that it plays across the region. Next slide, please. Okay, so how does the HAL work? The HAL is registered as a legal charge on the applicant's property, and it's registered as a percentage of the unimproved or anticipated improved value of the property. And depending on which local authority that we're giving the loan for will depend on which of that is actually applied. And for example, if the customer is having an extension built on the property to meet disabled needs, then we would do it on the anticipated improved value because the value of the property could increase significantly. There are no monthly repayments, and it's repaid on transfer of ownership of the applicant's property, usually through death or on the applicant's sale of the property. On repayment, the original percentage borrowed is calculated on a new valuation of the property or sale price to confirm what amount is repayable. And the customer pays for the valuation fee, the legal charge registration fee, and any lender consent fees. Now, in terms of legal charge registration, that's actually undertaken in-house again with the service. My team and myself undertook qualifications in land law and conveyancing to enable us to be able to do that as part of the whole service, so that we were not having to outsource the work to external solicitors, and we were able to significantly cut the costs to the customer. Next slide, please. So how does the HAL model work across the region? Initially, we all had the same criteria in terms of how, you know, a person is vulnerable, what works could be agreed, etc., and what the total loan to value was. But now, as the local authorities fund their own HALs, they've all got control over the specific terms and conditions of the HAL, but the model is still equity-based and repayable on transfer of ownership. Each local authority is responsible for determining their own vulnerability criteria and in accordance with the works in accordance with their private sector housing policy. The normal loan is 2,000, maximum loan is 30,000, but we have done several HALs across the region in excess of 50,000, and we've even done some HALs at like 80, 90,000 because properties have needed a complete overhaul for the vulnerable person that's living in them. So some local authorities only address minimum works that are required for health and safety reasons, but some authorities like Bradford, who's one of our key partners, they address all the issues that are identified under the Housing Health and Safety Rating System. Okay, next slide, please. So who is responsible for what? With our scheme, the local authorities are responsible for dealing with the initial enquiries that come in from the customer for financial assistance. They draw up the schedule of works and determine with the customer what works can be covered. They oversee the completion of the works to the local authority's satisfaction and signing it off as satisfactorily complete. And some local authorities provide a full agency service. So this means that the customer doesn't have to find their own contractor. A contractor is found for them, but there is a fee for that service. But that is what some customers prefer to do. And some local authorities also undertake the loan caseworker role if they have sufficient resources available. In terms of what my service is responsible for, we're responsible for receiving, underwriting and processing all the HAL applications, including the legal work and the administration of the HALs. And we also undertake the HAL interviews for some local authorities and training staff in other local authority areas to do them. So next slide, please. So I just wanted to include some points that, what to consider if you were to develop a finance offer of your own in your own local authority area. And some of the key points, I mean, I've listed quite a few points there, but the three key things for myself, for people to think about would be, what loan model type would you want to offer? An appreciation-based loan model doesn't need to be FCA regulated if it's administered by a local authority. But if you are going to be offering interest-based models, then they do, and an FCA regulation would be required. And you also need to consider, would you want them to be secured or unsecured? And if you do want them to be secured on the property, how is the legal work going to be undertaken? It's incredibly important to make sure that you can meet equality requirements, particularly in terms of Sharia compliance, and making sure that the loan principles and how it works meet the Sharia faith. And again, it's important to assess the demand and need in your area, just so that you can get a feel for the amount of funding that you would actually need for your area if you were to actually launch a scheme in your area. Next slide, please. Okay, so what makes a successful loan offer? Things that have helped our success has been having clear roles and responsibilities for each stakeholder who takes the customer through what parts of the loan process. It's a very important part of the process to support the customer from the beginning to the end. We need to make sure that they are fully aware of what is involved when taking a loan on. It's important to have clear marketing information that's easy to understand and uses uncomplicated language, particularly if it's equity-based or you've decided that you're going to offer loans that have interest applied to them. The customer needs to understand what that means to them. It's important to have information available on your website and that it's shared with your relevant partners and your stakeholders. But also being able to offer a choice of the customer finding their own contractor or using an agency service at their cost. Having loans available as a financial choice to use as a DFG top-up or to help disabled customers move home if their home is not suitable to meet their needs. And one of the loans that we have developed in Sheffield that we are using at the moment is to help people relocate from their existing property, if it doesn't meet the disabled needs, into a new property. And that is something that we are finding more and more is becoming needed in the Sheffield area. It's incredibly important to give the customers the opportunity to include family members, any friends or support workers in the process, particularly if there might be any inheritance issues in the future, or if mental capacity issues and understanding the detail of the loan might be of concern. And if capacity is an issue, then that needs to be addressed before you actually start taking the customer through the loan process. And it's incredibly important to have good working relationships with all stakeholders and partners so that the process runs as smoothly as possible for customers and that you can improve them where needed. Next slide, please. Okay, so I'm not going to go through all the points on this slide, but this was just to give you an overview of the impact that the Homes and Loan Service has had. We've helped improve the living conditions for just short of 2,000 people. in the 20 years that we've been running, and 930 of those were 55 or over. Reasons for customers not proceeding is that they decide that they don't want a loan. Some people were expecting a grant, but now in many areas like in Sheffield and in Bradford, the only grants that are available are such as the DFG. There are not, grants are not widespread anymore because loan is one way of helping people finance their own repairs, especially if they are equity rich but cash poor. So since we started operating the scheme in July 2005, we've actually given nearly £35 million worth of loans. And of these, 1,676 were HALs, amounting to just short of 26,000. And the average HAL is about 15,000. But as I said earlier, we've given HALs up to £80,000, £90,000. It's very difficult to predict when loans will be repaid because they are repaid on transfer of ownership, but our average redemption rate is about 6 years, 4 months. So we have been able to recycle funding to help more people from the initial tranche of funding that we first invested in the scheme. And of that, we've had 26 million HALs repaid. No, I think that's actually wrong. Apologies, I think I've got an incorrect figure there. Apologies, that's my fault. But we've had 613 HALs repaid, which has enabled us to recycle that funding. And as I said earlier, we've also developed relocation loans, empty property loans, which have helped local authorities bring empty properties back into use, and also foster care loans, which we have been delivering in Sheffield, which has helped our foster families be able to increase the size of the property and actually take on more children, or hard to place children. And we've got distinct evidence from how we've run our scheme that loans via local authorities do help people live in warm, weatherproof, safe and decent homes. And because we found because they are run, the scheme is run via local authorities, there is a real strong element of trust in the local authorities, and that we are helping people to achieve what we want them to achieve in their homes. Next slide, please. Okay. And I know I've put on my slide there any questions, but if it's okay, we'll actually leave the questions until the end of the session, when Ploy opens it up for everybody else, and I'm happy to take any questions there. Or if anyone has any questions they want to ask me and they want to get in touch direct, then please do via my email address. And thank you for listening.
Thank you very much for that presentation, Denise. And I'll pass straight on to Nick at the Parity Trust.
Hi, thanks a lot. Thanks, Ploy. I think you're probably going to find some similarities with our scheme as well. So just to give you a bit of background, if we can go to the next slide, please. Parity Trust is a not-for-profit organisation which is regulated by the Financial Conduct Authority, as well as being a registered charity. We basically specialise in delivering a range of secured loan products for homeowners, and our level of regulation also allows us to have the ability to offer mortgages for home purchase. We work in partnership with local authorities across Hampshire, East Sussex and Surrey to deliver a home improvement loan scheme, and essentially they provide the funding, which includes the bulk of the loan capital, which we manage on their behalf. I would sort of describe us that we are basically an extension of councils' private sector housing teams. And it's important to note that each local authority partner that we work with decides how the loans can be used. So they determine who is eligible and what works are eligible. Our main remit is to assess if a loan is suitable or not. Next slide, please. So the people that we support, we have a diverse product range, which I'll come on to a bit later. And this enables us to support people who are typically excluded from mainstream finance. A proportion of our clients are in receipt of benefits, such as universal credit, personal independence payment, or disability living allowance. We also assist lots of people in retirement whose only income might be limited state pension and pension credit. We come across cases where people are experiencing financial difficulty or have health issues, or sometimes it's a combination of both. And in summary, the people that we help require essential works to be carried out on the property in order to remain living comfortably. They typically have one or more vulnerabilities, in the main, little or no savings and limited options available to actually fund the works. Next slide, please. So the types of work that we help to fund, as I mentioned before, that's determined by the individual local authority partners that we work with. But we've sort of categorised them into four main areas to reflect where they've tended to concentrate. So we've got general home improvement loans, landlord and empty property loans, energy efficiency loans, and home adaptation loans. Next slide, please. We've been working closely with Eastleigh Borough Council since around about, I think it was 2005. They're a two-tier local authority in Hampshire. And I think they're a really good example to use in that we have administered lending for works in all four of the categories mentioned in the previous slide. Certainly an area that we're seeing an increasing demand for is the use of loans to top up a mandatory DFG. I think a number of local authorities that we work with have a discretionary DFG of up to 30,000 in addition to the mandatory one. Eastleigh at the moment have their discretionary amount. It's actually limited to just £5,000. And this is only available once all other sources of additional funding have been explored. So for clients that have a contribution, to assess this, we will carry out a financial review. And typically, if there's equity in the property, we can normally make an offer. Next slide, please. So how the model works, there's a lot that we're limited time today, but there's a lot of steps that I could go into. But in summary, that basically all of the loan administration has been outsourced to us. So that's from the initial inquiry for the full term of the loan up until the point where we remove the charge on the property. And one of the most important things, which resonates with the previous speaker, that we manage for our partners is recycling the loan capital, which can then be reused for the benefit of other residents. We've got a proven track record. We've never lost any of the monies lent out to clients. And to a degree, there's a sort of minimal risk on the basis that all of the loans are secured, ensuring that council's funding is safe. Next slide, please. An important part of the process, obviously, we're dealing with your residents, and as an ethical lender, we will only offer a loan if it meets our clients' needs. We're not there to sell. For those wishing to explore the option of a loan, we'll initially arrange a brief consultation and provide them with the relevant information about the scheme so that they can make an informed decision as to whether or not they want to proceed with an application. And also, if we feel there's a better solution available for the client, we will highlight this. And one of the most important part of the process is the initial financial review. So we carry out a robust financial review. Our clients will receive a copy of a financial report. Now, technically, we don't provide advice, but we will, where appropriate, offer guidance. And that's normally in areas such as money management. We might suggest benefit checks. And we'll also signpost people with debt problems to charities such as Step Change. The application process is straightforward for customers. There's no forms for clients to fill in. They're just simply required to provide the details we need to enable us to process their loan application. The reviews are carried out either online or via a home visit, and we will actively encourage other parties to be present for those that might need a little bit more support. And this could include sort of family members, friends, or sometimes local authority staff. Next slide, please. The success of our scheme, in part, is due to the range of loan products on offer. So we've got, as I mentioned a few times, all the loans are secured against the property. We've got a capital repayment loan, interest-only loan, interest roll-up loan, and a shared equity loan product. And I think personally, I think it's the interest roll-up loan and the shared equity loans that can help the most. With these products, there isn't a requirement to make a regular monthly payment. So we can therefore help people that have the equity in the property but can't afford to take on a traditional capital repayment loan. Some of the features of the loans, which is really important for clients, and they do take advantage of this. There's no penalties for overpayments or early settlement. The loans that have interest rates attached, they're fixed for the entire term of the loan. There's a very low arrangement fee of £150, which potentially, if required, can be added to the loan. Next slide, please. So basically, overall impact, we've helped to improve the housing stock, reduce carbon footprint. We've prolonged independent living. We can have a positive impact on people's mental health and well-being. And I think finally, we can sort of help make local authority housing budgets go further. We are involved in other projects as well. This is probably our main, what I class bread and butter business that we get involved in, but we do a number of other products as well. So I'd anybody that's interested in this scheme or anything else that we can offer, please take a look at our website or get in contact after. Thank you.
Thank you very much for that, Nick. And I will pass on to Paul from Foundations to share his reflections on this space and also how this links to the wider research that that Foundations conducted.
Thanks, Ploy. So some really interesting, I think, thoughts there from both Denise and Nick, and kind of reflecting on some of the things they said. For those of you who have been around a while, you probably remember that housing assistance policies came out about 20 years ago, and initially they weren't really around based on DFG discretion, which a lot of them are now very much focused on. That they were introduced to allow local authorities to set up loan schemes, and that's obviously where kind of genesis of the schemes we've heard today have come from. So, but if they were kind of very much a Labour Labour government initiative, so it'd be interesting to see if new Labour government can revisit that as a kind of policy around housing renewal. And I think the other interesting thing that you saw in both of those presentations was that the loan scheme involves collaborations and kind of partnerships, and quite a lot of that is done regionally. So a number of local authorities involved. So it's not kind of a single local authority that is developing the scheme. It's very much done in partnership across an area. That was probably a little bit easier when there were kind of regional offices, which were kind of also disbanded in 2010, 2011. But certainly that ability to work with others either across a county or across a more regional area, I think, is key. So that each individual local authority, and there's 297 housing authorities across England, aren't all reinventing the wheel in terms of delivering loans. For each of the kind of loans we've heard about today, I think there are three elements. I think we heard about the role of a kind of an organisation in terms of managing the financial elements of it. And we also heard a little bit about the kind of home improvement agency support for people in terms of kind of managing the improvement or the adaptation process. But I think kind of the other key partner that is particularly key for loans is a contractor. So you do need a good contractor or a good range of contractors who will do the work well and do it right first time. Because if you're kind of working with a vulnerable customer who is kind of taking out a loan and spending quite a lot of their own money in terms of improving that home, if it kind of goes wrong and they get a kind of cowboy builder involved, then that's going to be a big reputational risk for everybody involved. So developing a contractors list is I think key, and having good customer service from your agency and actually from everybody involved is going to be really important as well. And kind of from my experience, I think allowing choice and control for customers in terms of the specifications of what's being done to their home is key in terms of getting people involved in the process and kind of happy with the outcomes. Because sometimes these obviously kind of a grant to a certain extent is kind of free money, but a loan by its essence is repaid. And kind of property appreciation loans going back to the 80s and 90s got a bit of a bad name because that's kind of when house price inflation was at its peak, and also the kind of loan amount increases with the price of the house, and kind of back in the 80s and 90s, when house prices went through the roof, or almost literally, then that did become a bit of an issue. So it's interesting to see on Nick's presentation that there was a kind of a collar and cap figure on that. So the amount that it increased was capped to a certain extent. A lot of the schemes are also based on kind of local authorities or involve local authorities. And I think that has kind of pros and cons. So people generally, I think, trust their local authority and kind of aware that they're not a loan shark and that they're not there to rip them off. But perhaps you would naturally go to your council if you were looking for a loan to repair your home. So kind of marketing and promotion of a scheme to make sure that people are aware of it is really important. And I think kind of for any areas that are thinking about kind of dipping a toe into the kind of loan initiatives, that as you've seen, there are already some regional initiatives around it that you may be able to join. So Parity Trust, Lendology, but from Sheffield as well. But kind of a simple way to start might be by talking to your local credit union, who can quite often provide small loans for people. So if you haven't already spoke to your local credit union, I think that might be a good place to start. So that was my observations from the presentations this morning. So I'll hand back to Ploy for the Q&A.
Thank you very much for that, Paul. So if I can invite all the panelists to please turn on your cameras, and we'll go through some of the questions that have been sent directly to the panel, and also we have a few in the chat as well. I can see Paul Walker, you've raised your hand. I think as all attendees are in listen only mode, we can't actually hear you. So if there's a few people that raise their hands, actually, if you could please post your questions into the Q&A box at the bottom of your control ribbon, that would be great. But in the meantime, we'll start off with some questions. So one of the first questions is from the chat, and it was, is there unmet need out there? If your schemes had more money to lend, would you be lending more? And what more can be done to get that additional money? So a few different questions in that. Does anyone on the panel want to kick off on their experiences? Denise?
Yeah, I will do, Ploy. Thank you. I think that's an absolutely great question, Holly. The answer is yes. We have a huge amount of unmet need across Yorkshire and Humber. And I am 150% certain, had private sector investment not been pulled by the government in 2011 and we'd continue to receive government support, we would have continued, and we would have given far more loans than we have now and helped far more people, particularly those customers that cannot access a commercial loan because they don't take all the correct social boxes. They don't have the income, they're on benefits, they might have adverse credit information against their name. So yeah, definitely there is an unmet need, and I'm ever the optimist. And as Paul said earlier, the loan scheme came about because of the last Labour government. I'm hoping maybe a change of government might reignite some investment in private sector housing, because there will be many vulnerable people that just cannot help themselves, and they do put the trust in the local authorities as well. But quite how we do that, Ploy, I don't know. I guess it's working together to lobby the new government and to see whether we can get it further up the agenda, and demonstrate what the unmet need is across the country.
Thanks for that, Denise. Does anyone else want to add? Nick?
Yeah, I think all I would say is that where I mentioned before, the local authority partners that we work with, they all operate essentially their own scheme. So, for example, as I mentioned before, Eastleigh was a really good partner to pick because they've got more of a liberal sort of broad policy that allows us to deal with most customer inquiries, regardless of so the objective was always the property, to get that up to use, whereas in other areas they might specify that an applicant has to be between the ages of 63 and 65, and so the criteria can be quite tight in some areas. So to a degree, when we get a customer that rings us either direct or we get a referral from the local authority, it's a little bit of a postcode lottery, lottery essentially. So ideally, if we could offer funding for all sorts of different works in all areas, that would be great. Parity Trust have in the past utilised our own capital as well to help residents, where a local authority might have said, well, we're happy to do the bathroom and kitchen, but we can't do the roof of the garage because that doesn't meet our criteria. So in the past, we've actually done a loan to offer clients a full package. But we're not in a position at the moment. So ideally, if we could source some more capital so that we could expand, the range of works. But yeah, there's definitely demand, and there's more and more people struggling financially that I think need assistance. So it would be good if we had more investment.
Thanks very much for that, Nick. And I guess that brings us on to question around marketing, because it seems that there's kind of two key ways that areas seem to be kind of managing their loans, which is marketing, so figuring out kind of how widely they promote it, and also in terms of the eligibility criteria, as you mentioned, Nick. But I'd be interested to hear, are places actively promoting their local loan schemes? And yeah, do you know how places are kind of trying to balance that marketing with demand?
Yeah, so I'll attempt to answer that. It's basically, I guess with marketing, ideally, you want to do it on a continued basis and drip feed, all the time. But I think we found it's generally, it depends on the local authority, it depends on the comms team, and what we have found, unfortunately, it's sometimes quite difficult for people to know that there's something in place, because in the past, ideally you would want an applicant to go online to their local authority website, maybe 3 clicks, go into housing, help for homeowners, but it's rarely like that. You have to navigate and sometimes know that you need to go to private sector housing, environmental health, in the past. So I think what we've done in the past and continue to do is, look at partner organisations, charities in local areas. Obviously through the use of leaflets, we've just overhauled our website as well, get more into sort of social media, but we haven't got the funding necessarily to put hundreds of thousands of pounds into kind of marketing the scheme. So it does vary from area to area, and also depending on what that particular local authority is offering. So in the past, one example is local authorities have actually done a campaign where they have, if they've got an agenda to bring empty properties back into use, they've written to the owners of all the properties that they've identified in their area. So there's various things that you can do. But it's not, I wouldn't say that marketing is at the forefront of these schemes, and in part because there's only finite pot funding available.
Yeah, absolutely. Thanks, Nick. Did anyone else on the panel want to add anything onto that?
Yeah, I agree with Nick, Ploy, that because of the finite amount of funding that local authorities have, it's very difficult with the marketing side of it. So it does have to be managed very carefully, because but certainly with our scheme, whilst we've provided a suite of booklets that they can tailor to their own area, my service doesn't actually do any marketing of the service or the loans, because we're the administrator of the scheme. It's the responsibility of the local authority to do their marketing, but it will very much depend on the amount of funding that they have available in their area as to whether they will actually do any marketing. And certainly in Bradford, we've seen from the addresses, etc., that come through, quite often word of mouth is one of the best tools for marketing. We've done several loans on several streets, so quite often we will get repeat loans from one street in a particular area, and such as Bradford have done mail shots in the past, etc., but again, they have to tailor it and target specific areas depending on the amount of funding they have available in any financial year.
Thanks for that, Denise. Paul, did you want to come in?
Yeah, I think I suppose just kind of reflecting on the availability of funding as well. There was a similar scheme operated across the West Midlands back about 15 years ago, and that one did have to kind of close in 2011 when the funding was cut. But the big jolt just before that was the kind of financial crash around 2008, and just before that happened. Two or three of the big banks were really interested in the model and investing extra money and to really grow the kind of a very similar loan model to the kind of HAL one that Denise has just discussed. So I think kind of one of the opportunities potentially going forwards is working with some of the banks and big finance institutions to see if they would now be interested. Now kind of things have settled down a bit since 2008, but that would have significantly scaled up the operation across the West Midlands, and it's clearly there's kind of a demand and kind of potential opportunity to take that forward as well in the future, as well as it being just public funding.
Thanks very much for that, Paul. And that actually brings us on to a related point, which was, so a question from Holly. So are people more willing to take loans from local authority schemes than from the high street? People can be quite hesitant about loans. So is there more trust? How do you build that? Would anyone like to kick off on that?
I can share our experience, Ploy. I mean, yes, I think that's a really good question, Holly. We've certainly found with our regional scheme that people do have a higher level of trust in the local authority. And I think it's very much about making sure you have staff in place that are confident with the process. They know, how it can help the customer and how they can talk the customer through it. And it's making sure that whoever undertakes the loan interview with the customer, whether it be a local authority member of staff that we've trained or whether it's a member of my team, that we take them through step by step and we give them all the information to make a fully informed decision. And we recommend on all the documentation that's sent out and throughout the scripted interview process. And even though we're not FCA regulated, we very much followed the principles of the FCA, and it is a scripted interview that we carry out with the customer. And that's why we encourage on having family members involved, etc., and so people there to support them, so that they can see and we can build that trust with the customer before they complete the whole process. But we do strongly recommend that if they've got any doubts, or the family have got any doubts, then to obtain their own independent legal advice or their own independent financial advice, or both, just so that they can get that independent perspective compared to the local authority. So yeah, we have found that, yeah, there's certainly a higher level of trust when the local authority is involved, particularly, as Paul said, when we're looking for contractors and they're using an agency service, because for some vulnerable people and particularly elderly, it's a really stressful time. If they're having a lot of work done on a property, some of the loans, as I've said, have been £80,000-90,000. That's a huge amount of work for a vulnerable person to live through. And they've needed that hand holding, and they've needed somebody to support them on the whole journey from the start to the end.
Thanks for that, Denise. And yeah, that's something that has come out through the Centre for Aging Better's wider work and the Good Home Inquiry, is that one of the barriers, although finance is one of the key barriers to people making changes in the home, there's a lot of barriers around kind of how to find and identify trusted tradespeople, how to find independent information and advice. And there's definitely a role there for support in that way. Did any of the other panelists want to come in on that topic of building trust?
Yeah, I think basically fairly similar. What we found out from a long time ago, and we actually recruited a marketing company as well, but the most powerful brand for us is our local authority partnership. So people will not know who Parity Trust is. We can say we're regulated by the Financial Conduct Authority, but so I think that's a really important part of it. So we essentially, when we have conversations with our clients, we'll say, look, technically the loans come from Parity Trust, but actually it's a bit like a council loan in the fact that the bulk of the loan capital comes from Eastleigh Borough Council, or whichever local authority it happens to be. So that's a huge part of it. I think another important point though is, a number of the applicants that we applications that we receive where people haven't necessarily got the ability to source, mainstream finance, but they really urgently need the repairs. They're not, they're just concerned to a degree about getting the works done properly, for which our local authority partners can help with, and getting the funding for that. So I think Denise mentioned in her initial presentation about being a lender of last resort. So we get another number of applications, like I said, but essentially people are desperate to get, the works done, and we have to, we take a lot of extra care to make sure that first part of the process, carrying out the initial financial review, engaging with other family members, etc., is we do that really thoroughly, and it's kind of refreshing because I think with the scheme that Denise operates as well, as I mentioned before, we're not there to sell. So I've come from a long time ago, used to work for a main high street bank, and the agenda was probably more on the bank and sales, whereas here we've got nothing else to sell. If a loan's suitable, brilliant, that's fine. If not, so it's a non-sales type process. We'll give the customer the information, we'll carry out a financial review, present them with a loan illustration. If they want to go ahead, fine. If not, so it's sort of doing a lot of hand holding initially, but we don't find too much resilience in terms of people don't want to take out a loan, because in the main, most of them do really need that support and help.
I would agree with you. Sorry, Ploy, just to come in on that point, Nick, that like yourself, myself and the rest of my team have all come from commercial banks.
Right. Yeah.
And we moved across from our, with mortgage qualifications, etc. And obviously in that environment, it was very much sell, sell, sell. This environment is totally different. It's not target driven. There's no pressure on the customer. They're given plenty of time to make, really well informed, considered decisions. And, that's really key to making sure the customer understands that. And like I say, for us, involving family members is really one of the big parts, because we have had, unfortunately, when people have passed away, that their relatives will be unaware of the loan and they will come back to us and challenge it, and say, not want to repay us, etc. But again, like Nick and his service, we've been very successful with the repayments that have come back in. And out of all the loans that we've given, we've only had to write off one loan because the property had fallen into negative equity. But yeah, it is certainly something to be very aware of, that getting the families involved can help build that trust as well.
Yeah, thanks very much, Denise. And so I'm afraid to say we've come to the end of our time now. So Paul, I'm sorry you've not had a chance to come in on that last question. But I wanted to thank all of our speakers today for taking the time to be here to present on their work, as well as all of the audience for attending. If you would like to hear more about this work, and I know there are some questions we haven't responded to, we will be in touch with those who've asked questions that we've not been able to get to during this webinar. But if you'd like to hear more about this work, we're looking to make a change to your home improvement offer, do please get in touch with us. And I'm sure the panelists would also be happy to speak to anyone that's interested in speaking to them as well. Something worth noting, Centre for Aging Better, we actually run a good home network that brings together local authorities from across England to share learning, encourage peer support, and inspire innovation in home improvement services. Some of you who are for local authority may be interested in joining, so do get in touch if that's something of interest. Links to the resources we mentioned today, including all of our various reports, can be found in the Zoom chat, and we will also send them around to attendees afterwards, along with slides from the day. We would also love to hear your feedback on the session today. So one of my colleagues will be launching a poll, if you could do that now, please, with 2 very short questions. And if you're able to respond before you log off, it should take approximately 15 seconds, very quick. That would be brilliant. And as mentioned at the beginning of this call, so this webinar is the first in our new series focusing on poor quality homes that are aging better. So our next homes webinar will be on building effective home improvement services, and will be taking place in October. Following this, our webinar in November will be focusing on housing quality and people's health, and specifically making the case for improving health through housing. So you can find out more and sign up to these events via the links provided in the chat. And lastly, I also just wanted to mention that nominations for the National Healthy Housing Awards run by colleagues at Foundations have just opened with a deadline of Friday, the 13th of September. Again, you can find out more in the chat, including how to make a nomination. So thank you again to all of our panelists and all of our attendees. And if you've completed the poll, you're free to log off. Thank you very much.